MC, what's going on, man? Oh, we got four folks in here now. Trying to figure out the best way to do this bad boy. All's great, man. All's great. Just chilling on the balcony. Trying to figure out the the phone's too far away. I'm trying to use the phone because the computer doesn't have the best camera. I'm trying to use the phone, but then I'm using my other phone so I can read comments and stuff. So we'll see how this goes. Ah, I could turn it towards the mountains if you want. It'd be easier, I don't know. But yeah. So I guess we'll get this started out. There's about three of you in here, but just wanted to sit down with y'all. Don't really necessarily have any specific topics for today, but really wanted to sit down and discuss a few things. Mostly wanted to talk about, I think a lot of people have a lot of anxiety about jumping into the market, and they need to, oh, it's a party boat going by. That's awesome. I think a lot of people have a lot of anxiety going into the market, and they need to just understand that if they have the solid plan and they have an idea as to what they want to get out of investing, that they shouldn't have as much anxiety about it, and they should just go forward and try their best. And if they don't just start investing and try to learn as they continue through their journey, then they're never going to get started, and they're always going to potentially regret what they're doing. So hey, John Z, not yet, but I can talk about that right now, um, and hopefully it'll be beneficial for you. So most of the time when I look for dividend stock analysis, what I'll do is I'll look for price to free cash flow. Most specifically, looking for that it's, depending on what business it is, that it's preferably below 15, but I generally try to look for companies that have a price to free cash flow below 10. And so that has been happening a lot on a lot of bank stocks at the moment, whether it's Canadian banks, US banks. Caterpillar is doing pretty well as well. I'll move this away from the sun so you can get a better view. But also, I think one of the things that a lot of people do, and one of the things I first learned about, was price to earnings ratio. And what I've realized working in corporate business over the past 6-7 years now, is that the earnings that you get at the end of the year can be heavily manipulated on the positive and negative front. And what I mean by that is, if you just look at what happened in 2017 when the US had a lot of tax cuts, a lot of businesses were able to immediately have massive earnings growths for that year. And even though they didn't have any more cash flow potentially coming in, just because of the impact on taxes, they were able to have a massive influx of earnings. And so you can almost manipulate that bottom line. Whereas free cash flow, you can't manipulate that. That's actually money that's coming into the corporation. That's money that's actually hitting the cash register month after month. And so while you can manipulate earnings through other things like depreciation, if you're getting past taxes and stuff like that, companies like real estate investment trusts and other capital intensive businesses like railroads, oil and gas companies, pipeline businesses, they can depreciate a lot of, we got a fly here with us, got our eighth viewer. Those negatively impact your earnings, but at the end of the day, that's still money coming into the cash register that people can write off. And the reason why they write it off is obviously so they don't have to get taxed as much. So if you're saying the 40% effective tax rate of a business is going to be impacting that $10 billion, if you're able to write off, say, $3 billion, you're able to save 40% of that $3 billion because of your effective tax rate. And so while that 7 billion shows up, right? The 10 billion minus the $3 billion that you're writing off because of depreciation. That's what's going to show up in the price to earnings ratio. But in actuality, what came through the cash register from operations and rental income or just normal cash flow from operations, if you're not talking about specifically real estate, that's actually going to hit the cash register. And they can actually give that back to investors through dividends, through cash buybacks. And so that's preferably what I use to evaluate my stocks rather than price to earnings. But it also depends heavily on what businesses you're looking at too, because I mean, I mostly look at real estate investment trusts or normal corporations, banks, industrials, financials, energy companies. And so I kind of have an idea as to what I'm looking for in those businesses. But when it comes to something like technology or like a Twitter or something like that, I don't necessarily know what I'm looking at. So it makes it a little bit more difficult for me to evaluate those businesses. But a lot of those businesses don't pay dividends, so I'm not really investing in them a lot of times anyway. So hopefully that helps a little bit. So there's seven of you on the call. Curious what other questions you guys have. Now 8 of us, 9 of us if you count the mosquito that was hanging around a little bit ago. But like I said a little bit earlier, I think one of the key things that a lot of my friends that I've been talking about have angst with is really just getting started. And no matter how many times you tell them, and I talked to someone about this on a Friday, is no matter how many times you tell them, I understand why it's not getting through. Trying to set up certain businesses, or not set up certain business, to start to set up certain accounts so that they can invest in actually going and investing. And I can understand that mental barrier because I've been there as well before. But I think what it is that if you have that mental barrier where you're not necessarily jumping immediately in to the market because you're afraid that money is going to go down, you're emotional about if it takes a 30% dip or what have you. I think that just means that you need to do a little bit more research. I think that means you just need to study it a little bit more, because eventually if you study it enough, your mindset will click. And once it clicks for you, it'll be this whole nother level that kind of opens up. And I think what that means is you kind of have to have a formal plan. You have to have the right goals in there. You have to invest your first $1,000, and then I think you also need to just keep investing. And that's a video I made, yesterday. But also, one of the things that you need to do is you just need to keep harvesting it. You're gonna have this little uncertainty when you're first starting out, and I had the same thing, and I think everyone does. You don't necessarily know what you don't know, and that's scary. But I think another thing that people need to realize is, and maybe this doesn't necessarily go for people that are seeking capital appreciation, so take this with a grain of salt, but if you want to do dividend investing, long-term dividend investing, it doesn't matter if the market goes down 20% next year, 30% the year after that, as long as in, say, 20, 30 years, the company's still around and you're still getting those dividends. And I think that a lot of times people look at 1 year out, 2 years out, and they don't look at the long-term picture. And if you have the right plan and you have the right objectives and you know what those objectives are, you're not going to be looking at 1 to 2 years out. You're going to be looking at 10 to 20 years out, and then you'll be able to make the right decisions. I think a lot of times people don't have the right strategy in play. And so what they'll be looking at is they'll be influenced by watching CNN, they'll be influenced by watching Fox Business, they'll be influenced by, and they'll say, this is the stock to watch today, it's up 10%, or the stock's down 20%. And that may or may not be important to you. I love watching those shows. I love watching Fox Business when I'm at home visiting my parents. The 1 or 2 times a year that I get back there, because they have all the channels, and I generally just watch my news articles on Seeking Alpha and everything like that. But Tesla going up 20-30% might not necessarily matter to you. If you're a dividend investor, you don't care about Tesla. And so I think that is kind of what you need to do. And this is with all aspects of life. It's like you're always going to be getting thrown information at you, for sure. I mean, these days, social media, I mean, everything's coming at you at 1,000,000 miles a minute. But I think what the most important thing is, if you don't focus and you don't understand what information you're looking for, it's just going to cloud your judgment. And I think that's what happens a lot of days when people get started. Now, do I think it's the best time to invest if you're a capital appreciation investor? Probably not. Especially because if you're a capital appreciation investor, you're caring that your money doesn't go down. But I mean, there's a lot of good buys, in my opinion, in the market right now. If you're a dividend investor, I wouldn't be jumping at, say, Microsoft or Apple or anything like that, because I think that those are relatively well valued, maybe overvalued if you want to get specific. But anyway, I'll take a second and see if there's any questions. So I guess if you're looking for books, John, the one thing that I would probably look for is, if you haven't read it already and you want to be a dividend investor and you have your plan written and you're kind of looking and you're like, well, dividend investing seems like it's something for me. Warren Buffett always preaches The Value Investor, and that's by Benjamin Graham, I believe, and that was what the professor he studied with at Columbia University, I think, and that's a pretty good book. I read it while I was waiting. I had a long layover in Chicago about 2 or 3 years ago, and I was reading that book. I didn't buy it, which I should have, but I couldn't justify. I think it was like $35 or $40. It was a hardback copy, and I was just like, no. Good book, and now I kind of regret not buying it. But it is what it is. But I just, at the moment, I couldn't justify $35, $40, and I think I was still relatively early in my investment career, so it didn't strike me immediately that that's something that I wanted to own forever, but now I kind of regret not buying it. So I think that's a really good one. You can get that on Amazon. And I think another good book is, just for the mindset sort of thing, is Rich Dad Poor Dad. I think is a really good one by Robert Kiyosaki. If you're just looking for that mindset, it's not necessarily going to tell you about the metrics that you're looking for or anything like that. It might have a little bit. And I think another good one is, if you're looking for more of like metrics and how to evaluate stocks and stuff like that, it might be more towards capital appreciation and timing markets and stuff like that. Oh man, I had it somewhere. Now it's probably in a box because everything is boxed up from the move. But it was a Jim Cramer book. It wasn't his first book, but I think it was his second book. And man. Anyway, if you can find out what Jim Cramer's second book is, I think that's probably a good book, and it's not going to tell you about dividend investing per se. But I think another place that you could look is Investopedia. That they got a lot of good stuff. I mean, you can use any website, but I think the best thing for you to do, and other people on YouTube also preach this as well, is learn how to read a financial statement. If you're able to learn, the cash flow aspect of things, the top line revenue, the bottom line earnings, how it got to the earnings, how much a company's getting taxed, things along those lines. I think it's going to put you in good headway, um, and give you a good tailwind for the future of your investment career. But I think what a lot of people do is they rely on, for instance, people like myself, or they rely on people on the internet to be like, I bought this company, and then they'll just be like, yeah, that sounds good, without really putting their own effort into it. Or they'll just say, well, the stock was X at one point, and now it's Y. At this point, I'll wait till it goes back to X before they invest. And I mean, I feel like what a lot of people do is they invest based off of emotions, and that might be right. I mean, it just doesn't work for me, so I don't ever really do that. I invest off of hardcore numbers, and I, wait to look for if a stock is meeting a certain criteria, and if it is, I'll purchase it. If it's not, I'm not going to buy it. So like, I'm not going to buy a bank that's trading at 20 times free cash flow. Like, it doesn't make sense. So, but that also being said, if a business is growing like Google, I'd be more willing to buy Google at, say, like 18 times price to free cash flow, because I know that their free cash flow is probably growing, or their earnings are probably growing, or their revenue is growing. And so, you kind of have to play that holistic game. Is, the numbers are always telling you something, and they're always leading you somewhere. It's up to you to interpret it, right? So I mean, if you're thinking about like an AT&T, and it's trading at like a 20 times price to free cash flow, I mean, unless they do some crazy deal, or they change their company agenda and their company objectives, I mean, I'm not going to buy the company at a 20 times price to free cash flow. And so hopefully that helps out a little bit. I know it doesn't necessarily directly answer your question, but I think another thing you need to realize is or look at is, and I think I touched on this a little bit earlier, but I wasn't maybe specific enough, is every industry has its key metric that you want to look at. So, for instance, I don't invest in a lot of tech companies, but startup companies, they look at revenue growth. Like technology companies like WeWork, Uber, stuff like that, they look at revenue growth. And then they also look at like monthly average users for companies like Snapchat and Twitter, where like they make their money off of people that are actually using their services on a month-to-month basis, and they can use that for ads and understanding how much they can get, because it's all interrelated. How much you can get per user for ads, and how many times people are using it per month, and helps people and the analysts try to understand how much the business can potentially grow in the future. And then companies like banks, net interest income is a really big thing. And companies like real estate, it's like cash flow from operations or adjusted funds from operations. That's like the money that's actually coming through the door that they can then use to pay down debt or pay out to shareholders. And so every industry has its key metric that you need to utilize to understand the business. And so I had somebody tell me the other day, or not the other day, but probably 2 years ago, like, why would you be investing in Realty Income Corporation? And this is back when it was like in the 40s, 50s, about 2 years ago. And the price is irrelevant, but they're like, the price to earnings ratio is 45. Why would you do that? And I'm like, man, like you, the person I was talking to owned real estate. So I'm like, for better than I do. I don't own physical real estate, but I was like, better than I do that price to earnings ratios on a real estate investment trust are useless, because the earnings can be manipulated by all the depreciation of all the assets that they own. And so what's really important for real estate investment trusts is price to funds from operations, price to FFO or AFFO, adjusted funds from operations. And if you can get that down to below 15 or 10, I mean, that's optimal, because you obviously want to pay, the amount that they can actually get from funds from operations, at the lowest multiple possible. So keep that in mind. Let's see what else we got. Looking to pile on a Johnson & Johnson. All right. Yes, the intelligent investor. Thank you. Um, mm, so utilities and materials. Um, so I can't speak for all materials companies. The only materials, I don't have a lot of utility companies either. And this specifically, this question goes to STN 86. Um, I don't invest in a lot of utility companies. This is something that I've never really seeked out. I think the thing being is it's very capital intensive. They're somewhat regulated businesses, especially when you get to like electric and water companies, and that's somewhat scary. High debt most of the time, and with that, it's for me, it's a little bit harder to read the balance sheet. It's not as easy as cash in, cash out. They do a lot of debt refinancing and things like that. So utility companies, unfortunately, I try to stay away from. I should know about them a little bit more. So that's probably a weak part in my investment strategy, I would say. Materials, I'm also not fully developed on that with my wide array. I think it's a little bit more difficult to say, other than like the real estate investment trust, because real estate investment trusts are kind of their own. Um, and it's easy to just be like, okay, price different funds from operations. Materials are a little bit different. Materials can be anything from like chemical companies like Dow or um, crap. What's the other one I was looking at? BNSF. No, not BASF. BASF, not BNSF. That's the Burlington Northern Santa Fe. That's the railroad company. I'm not talking about that. BASF, the chemical company. But then you also have things like BHP, which are natural resource companies. So they're really like mining, stuff like that. Only experience I really have is in BHP, which is a mining company. And let me just double check. I think that that is basically it. I might have reinvested in a, or not reinvested, but also invested in a materials company, but I'm forgetting that I am. And so let me just open up my stocks here and I can kind of get an idea as to if I do or not. But I mean, I think for those companies, I think that they are somewhat capital intensive as well. Like BHP is somewhat capital intensive, and I notice I say somewhat, not entirely. Um, but did I not buy any more materials companies? I did not. So BHP, I think, is still the only one. But so just be wary that I think I would evaluate materials companies like I would like a financial stock or anything like that. Um, Price to free cash flow, making sure they're not have too much debt. Um, there was a couple chemical companies that I saw, and I don't remember the names off the top of my head because I was looking at investing in materials because it is one of my lesser invested sectors. So I would just be weary that they don't have too much debt. Companies like BHP are really trying to pay down the debt, and I think BHP is in a really good position right now. And actually, I think if you can, and you really like it, I would look at BHP personally. I have a decent amount of it at the moment, and the way that their earnings are at the moment, I think I would maybe buy more. It's hard for me to buy more for a company that I know I already have an over 100% return on based off of what I purchased in the past. But I think with where they're at right now, the earnings are right now, and how they're priced right now, I think that that's probably a good company to get into as well. But yeah, that's just entertainment discussion purposes. It's not real investment advice because I'm not really an investing professional. So obviously consult somebody else if you, a professional, if you want to potentially buy in that. So there's a discussion going back and forth about Johnson and Johnson, as everyone's seeing in the live chat. Um, Interesting. Thoughts on Fidelity ETFs? So I really like a lot of Fidelity ETFs. I personally, it's where I keep, I would say, I don't know the exact number, but probably over 75% of my money is in Fidelity, whether it's through 401k, IRA, individual brokerage account. And just with those alone, yeah, I mean, easily over 65% of my money is in Fidelity. I like the Fidelity ETFs. I think the ones that I have most experience with were the commission-free ones. You could buy and sell those. Now those are kind of obsolete, sort of, kind of, because of the whole zero fee, zero trade um, thing that's going on. And it's getting kind of dark out because the sun's setting, so I might run inside and set up inside. Um, so if I go mobile, don't get too weary. But I think the thing that I really enjoy their ETFs. I don't mind them. I think that some of them though, especially the ones that were in the commission free, some of them were somewhat redundant in my opinion. So there were some ones that were the bond ones I didn't really like, but I'm not a big bond investor. And then there was some dividend ones that I didn't really like either, and I was just they were almost like half a percentage more yield than the S&P 500, and so I was just like, well, at that point, if I'm just chasing half a percentage yield, I'm just going to go with the S&P 500 one. Um, Specifically, like IVV is a really good Fidelity one that I've been chasing. The ones that I generally look at for the Fidelity are ITOT, which is the total stock market, and has a really low expense ratio. The IVV also has a very low expense ratio, and IJR is small cap. I really like that. And then I think there was a mid cap that I used to watch as well. It's the mid cap value, and I think that one's IJK. Um, but I don't remember exactly. But I really like the mid cap value as well. Um, so those are the ones I really put a lot of focus on. But there were some ones that I regret not buying in the past, like the India ETF. There was like an India top 50, and that's another thing with the Fidelity ones. There's specific country ETFs that you could look at. So whether that's India, I think there was a China one. There was like a international US, or everything but the US fund. Um, there was like a Europe fund, a Germany fund, and so in that respect, it was really good. There are some though that the one thing I'd be weary with any say mutual fund, whether it's Vanguard, um, sponsored mutual fund, or anything like that. Generally speaking, mutual funds are going to cost more in terms of expense ratios than ETFs. Generally, I would say. Just keep that in mind. I say generally. Um, and another thing I would look for is passively managed ETFs. And what I mean by passively managed is they're not actively managed, because that will help keep your tax bill down if people are buying and selling specific assets. Now, sometimes it's inevitable. Some companies enter into the S&P 500, some leave. So anyway, different story for a different day. But there are some ETFs in there where you'd be like, oh, that sounds really nifty, or that sounds really cool. And in all reality, it's basically just trying to match the S&P 500. So I would just go with IVV, which is the S&P 500 value fund, rather than trying to go with this like fancy one that is trying to be like the S&P 500, but it's not the S&P 500 because it's trying to attract more users into it. So I'll just be cautious with that. There was a couple where I'm just like, I'll just invest in the S&P 500 if that's the truth. But there are some really good mutual funds in Fidelity as well. There was one in 2013 when I started investing pretty heavily and looking to kind of like automate my investing, and wasn't really looking to do monthly management or active management of my portfolio called FBIOX, and it's a biopharmaceutical ETF. And that was one that I really looked at, but I never put money in because at the time it required $2,500 minimum. At the time, that was a lot for me because I was just starting out. This is like 6-7 years ago, so I never ended up getting into it. But had I would have done very well. Trying to think. But yeah, so I would just be wary. Make sure that you look at the expense ratios of whatever you're investing in for sure. Independent investor, thank you. Thank you for keeping me honest yesterday and really making me think. Really enjoyed your response back. And for those of you that don't know, I was asking him whether or not he's really a swing trader or if he's really a long-term investor. And he was just like, doesn't necessarily really matter per se. And what I interpreted as was, different accounts he's using different things for. But all in all, I really enjoy his content. And he does a really good job of explaining things, and he's very articulate, and that's something that I really admire about Ryan. I think it's Ryan. Hopefully I didn't mess up your name there. Very articulate, and so have a lot of admiration for him. Very jealous of his subscriber base. I have like 14, 15 people in here. He had like 60 people. He had like pages upon pages of questions, and so I'm really envious of that. I think that's why I was probably being rude to him in the comment section, trying to nitpick, because I was envious of how he gets to miss questions because there's so many of them, and he'd have to like scroll up to the top to like see all the questions. But yeah, but really cool guy. Really like his content a lot. So. Yes, I love it down here. Very peaceful. Very peaceful in Trinidad. Yeah, Ryan is the man. So is there any other questions? Otherwise, I think, what was so these of you guys that, we have a mosquito who's the 15th viewer on the channel right now. So if you guys see him around and he's swatting around, it's because he's out there. But we got some people headed to the pool right now to hang out. But one of the things I was thinking is I know a lot of people have a lot of anxiety about jumping into the market, and I think even if, say, you have $10,000 or $15,000, I know it's a lot of money. If you're really scared and you're like, well, I'm hesitant to invest that $10,000, $15,000, I understand. I've been there. I think that what you could do is take a fraction of that money, to say $1,000, and if you have a substantial plan, use that $1,000. It's not going to break your bank in that case if you have $10,000 to $15,000, and scale up from there. Once you feel more comfortable, you start learning. It's going to get easier, and I think that's one thing that a lot of people forget is everything that we do is something that we have to focus and concentrate and plan on. And if you invest your first $1,000, it's going to be very difficult for you. And I had a problem with that as well. I would be looking, and when I first started in 2013, I remember getting my first paycheck, and yes, I was still doing the 401k and stuff like that, but back then having $1,000 in a stock was huge for me. I mean, I was 23 at the time, and I was, $100 is, stuff that I would work whole weekends for, and here I am, just at that point, literally gambling it away because I didn't know what I was doing. And so I think you have a little bit more advantage now with the people that you have to look forward to. You got people like Ryan, Jeremy from Investing Education, or Financial Education rather. You got Investing Education, you got PPC Ian. And so use those guys as sources. And I'm not saying to just blindly follow them, but I think that if you have a stable plan, you understand what your goals are, you can really listen to all those sort of perspectives for educational purposes, of course, and formulate your own. If you're looking to do swing trading, listen to what Jeremy's saying over at financial education. If you're looking for dividend investing, you got me, you got Ryan, you got Ian, you got a bunch of other folks that you can use. JMac Investing is a good one too. He's starting his portfolio. He's looking good. He's got like $28,000 I saw. That's phenomenal. That's a good start to the money. So you got plenty of people that are just getting started, and maybe I'm not the best person to follow because I'm a little bit further ahead, just because I've just been throwing so much capital into the portfolio that you might not relate to me, and I think that that shows because a lot of people will gravitate towards smaller investors like that have $5,000 to $10,000 because that's probably what they more so relate to. But you have these people that have these experience, and you can use them almost to formulate what you do and don't want to do with your own portfolio. But like I said, if you want to be a long-term dividend investor, don't necessarily jump to do what Jeremy from Financial Education is doing, because he's generally a swing trader, right? He's generally a swing investor and will, I don't know if this is a bug bite or a mosquito bite, might be getting bit up. He might be, trying to swing trade Tesla because it went down to 220 last week and now it's back up to say 250 and he sells. So there's nothing wrong with that. I just think you just need to understand where your investment goals and objectives lie and what your plan is. And, I think that if you're able to do that, then you can help understand your journey a little bit better and make better decisions. So I'm a buyer of BHP. I just talked about BHP for me at the moment is over 100% return. Luckily for me, because I was buying it on its way down. I think I started buying in 2015 timeframe when it was heading from the 50s down to the 40s, down to the 30s, down to the 20s, and I believe it actually hit $16 or mid $16 at one point. And so I actually used to have over 200 shares of BBL actually, not BHP, but BBL. And once those original shares broke even, I sold them. So the 100 shares that I was buying on the stair step, and I had a tranche that I was buying between like 19 and 20 something. And so now the cost basis of the shares that I do have are about $22. And now that's obviously in the $40 range or so. So that with reinvested dividends, it's over 100% return. So I was just talking a little bit earlier that for me, it would be very difficult to want to buy something that has 100% return. But I think the company's throwing out a lot of cash. Their debt position is way better than it was back in the 2014, 2015 time frame. Hey, we got a gecko over there climbing up the wall. I think I would want to look at it again because I've kind of just been a bystander, looking at how well it's doing and waiting for the dividend to come in every 6 months because it pays twice a year, March and September. But I would probably say yes. I would probably, knowing how well it's doing, it's currently paying over a 7% yield. My yield on cost is like 14 something percent, 14 and a half or something percent. So in that respect, makes it a little bit easier for me to want to hold on to the stock for the long term. Let's see if I'm getting my numbers right here. Yeah, so it's yielding 7.6% right now, and my yield on cost is 14.2%. So it makes it a little bit difficult for me to want to sell, but it also makes it a little bit difficult for me to buy. But with a yield like 7%, and I think they're only paying out 40 or 50% of the free cash flow, I mean, makes it difficult, and their yield is doing really well right now. So think about it from that perspective. And anyway, all good. Now I'm hurt. I thought I was the best. I'm just kidding now. But I agree. Yeah, we have the ability to break down a lot of barriers. Um, yeah, man, you do one like every night, man. I'm real impressed by the numbers that Uncle Ryan's got over here. So, um, but yeah, next time I'll do a little bit of a show around. You can see some of the boats, the LNG boats coming in, and some of the rigs coming in. So thanks for stopping by, Ryan. I know you got to do some other stuff. Probably do your own live live chat right now. So David Walden asks, with $5,000, what would I invest in, and how much I would have in each one, and how many stocks I would invest in. Um, if you're just starting, it makes it a little bit more difficult. I think I'm gonna run to the kitchen where there's a little bit better light because you can't even see me anymore. Um, so just give me a second here. Fix this up. Grab this, and this, and this, and this. Whoops. Close these doors. Do I have anything out here that I need? I do not. All right. So the question was, with $5,000, what would I do? And the question is, I think with $5,000, if you're just getting started, it makes it a little bit difficult to want to put it all into one individual investment, and I can understand that because, like I was just mentioning a little bit earlier, when I was just starting out in 2013, even putting like $1,000 into a stock was scary for me. But I think if you're just getting started, and this is something I touched on a little bit earlier, if you're just getting started and you're nervous about what you're investing in, and you don't want to invest the whole $5,000, you don't have to. I mean, if it's as simple as getting yourself into an ETF or something like that for $1,000, maybe that's the way to go. And just getting yourself set up, the account set up, and so you can learn might be the most beneficial thing for you. Because I think what was hard for me to do was, when I was first starting, I was just kind of blindly going between dividend stocks and penny stocks and growth stocks. And what I ended up realizing was this penny and growth stocks thing wasn't for me. And so that way is when I really started to get honing in 2014, 2015 timeframe, that dividend stocks were for me. And not saying that they would be for you. That's something that you can kind of come up on your own, in your own opinion. But I think that if you have an idea as to what you want to do, just put $1,000 of that $5,000 in. And once you start feeling more comfortable, maybe it's more of a thing that you can do. And that way it also allows you to DCA, dollar cost average. If you don't know what that is, it basically means that if the stock goes up or down, it allows you to purchase it at a different price. And so if, say, you want to, say, dabble specifically in Johnson & Johnson, which might not be for you, but let's just say, for instance, and it continues to go down because all these litigations that are coming out, then you'll be able to purchase it not only at the high 120s, but maybe if it dips into the 110s again, like it did a couple years ago, you have that opportunity as well. But I think another thing that's important is understanding how active you want to be. Do you want to be someone that's looking at it every other day? Do you want to be someone that's looking at it 3 times a day? Do you want to be someone that's looking at it once every 6 months? And that will also help you understand whether or not ETFs or individual stocks is something for you. If you get a lot of enjoyment, like myself, out of looking at the investor reports, oogling at the numbers, being like, oh my God, they did what? Or if you get a lot of satisfaction out of that, like I do, then one, you're a nerd, and then two, I can say that because I am a nerd. But three, individual stock investment might be for you. And I think what a lot of things that people understand, and some of the folks in the WhatsApp group also have come to the realization they've sold all their individual stock positions and they've gone with ETFs because they, one, recognize that it's very difficult to beat the market. Individual stock investing is not easy. It has a lot of emotions involved, and sometimes just investing in ETFs is the best way to do it, and also the most economic in terms of you most likely will get the best returns out of it. Maybe you're, the next Warren Buffett, and you're able to invest in individual stocks and get 20% per year annualized. But I personally will forego 1 to 2% a year because I get a lot of enjoyment out of individual stocks, and I like knowing, when the investor reports are coming out. But for some people, if they're just trying to make money and just make sure that at the end of the day, their money's being invested wisely, maybe an ETF is for you. And so with that, you can invest that $5,000 across multiple ETFs. But yeah, just because you have $5,000, and I'm not trying to attack you here when I say this, but just because you have $5,000 doesn't mean you have to invest it all. And another thing is, don't just stop at that $5,000. I think a lot of people in your situation, and once again, I'm not trying to attack you when I say this, but they'll say $5,000 and they'll just throw it in there. And by throw it in there, I mean invest it in, say, one stock. And when I'm thinking about this, I'm thinking about a coworker in particular who does very little research, but they'll just choose 5 or 6 different companies. And some of them will do well and they'll sell and be a swing trader in that respect. And when they go up by a certain amount of money, they'll sell. But then some of them go down and then they'll sell out and they'll be like, well, I lost $30,000. Luckily, they have a lot of money to begin with, but they're like, oh, I lost $30,000. I'm staying out of the market. But it's like they didn't have a plan, right? And if you have a plan, you can get a better idea as to what you're looking for and the criteria at which you're going to buy something at and sell something at, if you're going to sell at all. And I think another thing is, if you're going to be consistent and you want to grow your wealth massively, you can't just put in $5,000 and expect to have it grow into 80 billion. You have to look at what Warren Buffett did, per se, as someone that I think the best analogy that I can give is if you invest in a business, say, let's just say you have a grocery store and you initially buy everything to give the grocery store fully filled. Let's say you own a Kroger. Once you sell everything, all the items in the Kroger, you can't just take all that money and expect to keep it all. And what I mean is, like, once you sell this bag of chips for $3.50, and once you sell that gallon of milk for $4, and once you sell, this Hershey bar for $1.50, you can't just pocket all that money. Only a little bit of it is yours. And so what I'm thinking with this analogy is a lot of that money has to go back into the business. You have to reinvest into the business, and you have to be very systematic and thoughtful about, if you're taking your money out of the business, how it might starve the growth of the business and how it might starve your potential growth in terms of your wealth building. I think a lot of people don't understand that growing a business and growing wealth, you can't take money out for many years. If you think about, say, like the normal mom and pop stores, a lot of folks live off of, say, minimum wage. Restaurant owners that are just starting up, they barely can pay themselves. They live off of credit cards because they're trying to either grow the business or the fact that they have to keep feeding the business in order for it to work. And so sometimes in the very beginning, you might have to do that. You might have to continue to feed the investment portfolio for it to continue to grow. And if you don't, it's going to starve and it's just going to fizzle out. And maybe, you know, it'll just not end up being okay. And you'll just be like, you know, I'm getting impatient. Investing isn't for me. And, you know, and I've seen friends that I've started with get frustrated and sell their portfolios and use it to buy a house. And I'm not saying that that's a bad thing. I personally, at the moment, because I'm so young, excuse me while I open up this Coke here. I personally am not a fan of buying a house because at the moment, as you can see, I'm living abroad, not inside the United States, for work reasons. And I might not go back to the United States next year. I might go somewhere else. So buying a home for me doesn't make sense. And I don't get a lot of appreciation for home ownership, you know, with just my lifestyle. I'm not a fan of that. And so I'm not downing anybody. I mean, my one friend, she was just like, but you don't want to buy a house. Like, why? And I'm like, don't base my, you know, my perception of home ownership on yourself. Would you want to be painting walls a different color? Would you want to be, and this is an analogy for everything, right? And I'm going to get into that. And she said, yes, I would like to renovate the home. I would like to decorate. I would like to make decisions about that thing, or that thing, or, you know, make sure that the right painting is in the right wall. And I said, well, then sounds like home ownership is for you. It's just not for me. I personally would rather, you know, do really well at building my business, building my career and my 9-to-5 job, building my stock portfolio. And that's what matters to me. And so I get a lot of enjoyment out of that. And what I'm getting at here is I think a lot of times people purchase things that aren't, they just purchase things to purchase things. And I know how it makes you feel. You get a little bit of endorphins every time you buy something. And I can understand that because, you know, I've fallen into that many times. But I think what they don't do is they evaluate, well, I can buy that thing because it actually makes me happy, but I'm not going to buy that thing because all it is going to be an endorphin buzz for, you know, the 2 minutes that I'm in line waiting to buy it, and then it goes away. And so if you're able to do exactly what Hidden Investor just mentioned, Hidden Freedom Investor, right? Crap, I'm sorry, I messed up your name. Yeah, Hidden Freedom Investing just mentioned, get out of that rat race, American way sort of thinking, and really only concentrate on the things that make you happy, whether that's family, whether that's your investing portfolio, whether that's home ownership. But like, if you don't like 4x4s, or like you don't like mudding, or you don't like, you know, one of the things that my one friend used to make fun of me about. So I had a car that was a 2009. It's not that old. Before I moved to Trinidad, I was driving this truck around, and a lot of my friends were like, dude, like, you make really good money. You're doing really well at your job. Why don't you buy a new car? And I'm like, well, this one works. I don't have a problem with it. And then I started thinking, I was just like, yeah, maybe I should. And then I started thinking about, what do I actually care about in a car? I care about air conditioning. I care if the windows go down. I care if it has a decent sound system and I can blare music. And I was just like, and that's pretty much it. And I was like, maybe I prefer leather over cloth, but I don't think a lot of cars have cloth seats anymore. Maybe they have like that weird nylon sort of stuff. You can kind of have like a halfway between cloth and plastic, or cloth and leather. But anyway, so I was just like, yeah, no, I'm gonna stick with my 2009 truck. Like, it has everything. The windows go down, it's got good air conditioning, and it plays good music. And I was fine with it. I was really upset when I had to sell it to come down here. Granted, I love working down here and I have no problems with it. But that was one of the harder parts about moving down here, is getting rid of the truck, because I was like, this thing's got, you know, however many miles left on it, I could drive it for a while. Excuse me. But anyway, so I think what I mean by that is, if you say have a bunch of different things that you invest in, and you or not invest in, you have a whole bunch of different things that you buy on a week-to-week basis, but it doesn't really give you any satisfaction, cut out some of them. Buy only the things that really actually give you satisfaction, and use that other money to invest in the market if you're really concerned about your financial future. And yeah, I mean, just get better at goal planning, get better at understanding what your future plan is, and that. So let's see what other questions some folks have. I think I accidentally got rid of. So let's see here if we have any questions. ETFs, agreed. Can't handle the volatility, you can understand that. Hidden freedom investing still drives the 2009 Pathfinder, it's understandable. What do I think about VIG? Yeah, that's David, that's a really good thing. I think one of the future videos that I'm gonna create is about automatic investing, and I don't want to say not trust yourself, but also I want to say not trust yourself. I think what a lot of people do is they see the money that's in their checking account and will immediately go and spend it. And if they have money in the bank and they have the financial freedom, or they don't have the ambition to retire early, I can understand wanting to spend that money. But I think a lot of people, I'll give a statistic, and this is something I was telling my one friend about. She was concerned because she doesn't have enough money, or comparing herself to how much I have at the moment, and she's slightly older than I am, and she's not doing as well financially. And we were talking through some of the financial steps she's taken in her life, and very different in terms of what she had been putting her money into in the past. But I think one of the key things is, where was I going with this? The amount of money that they're saving. And so to put it in perspective, I try to aim to 35 to 40% of my salary, gross salary, so not take-home money, but gross salary, into investment accounts. And so, of course, some of that includes 401k, and luckily some of that includes employee matching, but also that includes Roth IRA, of which is $6,000 a year. And then there's the multitude of other accounts that pull money out of my accounts every month. And so I'm fortunate that I get paid in the middle and the end of every month. And it's like clockwork. So instead of getting paid, say, 26 times a year, I get paid 24. And so I have very systematic amounts of money, and very routine amounts of money coming into my account on specific dates. And so it makes it easy for me to say, on the 15th of every month, pay off this credit card and pull money into, say, this account. And on the 1st of every month, put money into this account. And that way I can stagger and automatically have, funds going, between different accounts very often. And it's one of the future videos that I want to make. And also potentially not a course per se, but something that folks can use and get a little bit more information, I would say, about me and what I exactly put money into. But I don't want to say I don't trust myself, because at this point I think it's so automatic and so routine for me that I would definitely not be spending an absurd amount of money if I stopped investing in, say, all these accounts automatically all the time. But there would be times before I set this up where, I was still trying to set aside a lot of money all the time, but I would just forget it that month. Things were going on at work, or, I just, it got to the end of the month and, I had let's just say close to $10,000 in my checking account, because the past 2 to 3 months, I just hadn't been able to, invest it fast enough.
or I was trying to, save off to buy something, or and I never ended up doing it, or something like that. But if you are consistent, and sometimes it gets me into trouble, because sometimes some months, I kind of have it set up to where routinely I'd say about 30%. I have it set up so that like I can spend 30% of my gross income. So obviously taxes come out a lot of that. But then I have 40%, 35 to 40, maybe even close to 50% going into my investment accounts. And then that kind of leaves 30 to 40% for me to kind of live off of and play, depending on how much taxes get taken out. And so what I was trying to go with that is, sometimes if I have a big spending month, like if I have Christmas or something coming up and I have to buy plane tickets and stuff like that, it might get a little stressful, because sometimes I overinvest. But I think if you set up stuff like have a personal savings account and you have a slush fund of a couple months' salary, that if you have one of those big months, then it's not that big of a deal. I can't tell you how many times I've been like, wow, this might be cutting it close in what's in my checking account. And I just go to my personal savings account with Amex and hit transfer and, add another $1,000, and it's not a big deal, because I have probably 10% of my money go into a personal savings account every month. And once that personal savings gets to a high enough number, I'll either shut it off or immediately take that money and just put it into my individual brokerage account. So there's that aspect of things. But yeah, a lot of not many questions. Oh, I didn't answer Lord Slade's question about VIG. So I like Vanguard funds. Vanguard is actually very close to where I grew up. So I know a lot of folks that have worked in Vanguard in the past. Great people, great company. Really support their vision and really support what they're doing with respect to the ETF community. And really nice facilities as well. If I probably wasn't living in Trinidad and Tobago and working for the company I would work for, I know like 5 or 6 people that work there. So great people. I know some people that have left and gone to do other finance related things, but really good people, really good place. And they're doing a really good job for the community. I don't have a problem with VIG. VIG is good, especially if you're trying to get a slightly higher dividend yield. I think they aim for 3 or so percent, so it gives you a little bit more than the S&P 500. So in that respect, I say keep it up. I think they have a pretty low expense ratio as well, but I'm not as familiar with the Vanguard funds because I don't have Vanguard. So there's that aspect of things. So yeah, curious if there's any other questions. Like I said, I was telling people earlier that I get jealous of Ryan from Independent Investor because he gets so many questions that he can't even answer all the questions coming up. So let me see if I can put this down instead of holding it. I have like a wallet attached to the back of my phone, so I might be able to use that to balance. Sorry, while I fix this a little bit. That's good. David Walden then asked, do I read company reports and balance sheets, and what do I look for? So I answered this a little bit earlier in the live stream, but I can understand people are kind of shuffling in and out. I would generally look for most companies, a price to free cash flow. And reason being is because earnings can be manipulated. Depreciation, amortization, and other one-off sort of items can decrease that earnings number. And so that would then deflate or artificially inflate the price to earnings ratio. There's that aspect of things. So generally speaking, free cash flow, you can't hide that unless you're really good at financial engineering. But price to free cash flow is something that you really can't manipulate. And so Generally speaking, I look at that because that is really tried and true, and that's what's actually coming into the cash register. That's what's actually, going back into the company treasury. Whereas earnings is kind of, there's a reason why they have GAAP and non-GAAP earnings and stuff like that. And GAAP means general allowed accounting practices, and it's like, for me, it's just like, well, if you look at an earnings number and it's non-GAAP and it's one thing, and then you look at GAAP and it's another thing, it's just like that. Just for me means that you can't trust the number. So I prefer, yes, the numbers are probably real, and, one of them allows you to include some things and not the other. But, just for me, it's just like free cash flow doesn't change between whether or not it's GAAP and non-GAAP. So it's like, I'd rather use that number, and it allows you to actually find out what can be used to pay. Hey, all good, thank you, I'll talk to you soon. I'll try to see when the next live stream is. I generally end up doing them on Sundays, but anyway, have a great night and sleep well. The free cash flow is actually what's used to pay out the dividend. Earnings, not necessarily. And so, if the free cash flow is there, then they can actually use that to pay the dividend. Earnings, I know, so one thing I would be concerned about is payout ratio is generally based off of earnings, when in actuality, you should be concerned about if that payout ratio is covered under free cash flow. Because earnings, like I said, can be manipulated. Might show that a company has $1 billion in earnings, but the free cash flow is only, say, 200-300 million. And so a lot of companies, like let's take railroad companies, pipeline companies, oil and gas companies, they're all capital intensive businesses. And so while they might make $1 billion, let's say, they have to use a portion of that $1 billion to invest in future projects and get a return on capital invested for the company. And so if they're investing $1 billion, that means they have to go into debt and ask debt holders and issue bonds in order to pay the dividend. And who wants that? You know what I mean? Like that's not sustainable. That's not the sign of a healthy company. And so while the earnings might be good, right? The earnings might show that they have the earnings to pay out that money. The money is actually paid from the free cash flow, and the dividends paid from the free cash flow. And so if the company has $1 billion in free cash that they have at the end of the quarter, and they pay out $500 million, then they have $500 million that they can either use to give you more dividends or issue towards debt, and so it just allows you to understand a little bit better where that cash can be used. And so if I were like an investor, specifically looking at buying the whole business, I would try to look at what the free cash flow is, what's actually going to come in to the company's pockets at the end of the year, and so that I can understand whether or not I'm putting it here, putting it there. And then I think another thing that's really important is capital returned. So return on average capital, and that's an important value because obviously if the company's going to take a portion of that $1 billion that they earned and invest it, how much are they actually going to get back? And so this is really important with a lot of businesses that have capital on the books, like 3M or a lot of companies that have very long-term facilities, like BHP, pipeline companies, because they have a lot of capital put into these businesses, and they have huge depreciable, asset bases. How much money are they actually generating from those? And that's pretty important. But anyway, I think I deviated slightly from the question. But yes, I read the company reports and the balance sheets, and I look for free cash flow most of the time. And if the company is able to pay my dividend from the free cash flow, not the earnings, because earnings can be manipulated. So the question from Hidden Freedom of Investing: am I looking to retire in the U.S. or strictly abroad? I've seen your retirement goals. It would be tough to retire in the U.S. unless you retire overseas and let it grow and then come back. So my near term, so I guess there's multiple different ways to look at it. So in the next 2 to 3 years, I hope to get to around $40,000 to $50,000 in dividend income. And so I can understand why you would say it's difficult to retire in the U.S. for that. But that doesn't mean I'm going to stop there. I'm hoping, and that's, while I say I retire per se, doesn't necessarily mean I will. But the goal is really, and the point at which I really think I'm going to get to when I have to make a decision as to whether I'd retire, is the $100,000 number, which is more the number I've been speaking to a little bit more lately. And granted that first goal is that $48,000 to $50,000 number, so I can understand where the hesitancy would be for that. But I can understand why you might say, supporting a family on $100,000 a year might be difficult as well. But like I said, that would hopefully be by my mid-30s, and anticipate having other businesses as well, hopefully contributing to that, or also still working at my current 9-to-5 job, just at maybe a different position. But that being said, I've thought about in the past, before I maybe go into, say, management or something like that, taking a 3-4 month say sabbatical or whatever they call it, but a non-company paid for extended vacation, and go and live in, say, Southeast Asia or something like that. I think moving to, say, Trinidad was a very big step for me, because I went from living in the U.S., which is the only country I've ever known, to now living in a foreign country that has 1.4 billion or 1.4 million people rather, and a very different economy compared to the U.S. And so it gives me, in my more up-to-date goals, it's less financial. Well, it is still very financially driven. And I saw Green Ghost join the chat room, so hello, Green Ghost. But in there now, by the time I'm 50, I want to hit 50 different countries. So by the end of this year, I'm hoping to get to, I have booked flights now for 9 countries before the end of this year. So I'll be meeting up with passive income investor in Toronto next week. I still need to reach out to them and solidify some agreements with them. See if we can meet up on Sunday and going into Monday, so like a week from now. And then from Canada, I will be going to Turks and Caicos, and then from Turks and Caicos, I'll be going to Antigua. So that'll be a lot of fun. Hey Hassan, how you doing? And so that'll be 9 countries out of the 10 that I was hoping to get to by the end of the year. And so that gives me basically 2 months to add on to some weekend, whether it's for Thanksgiving or Christmas, for me, to stop by another country, whether that's the Caribbean or Europe, or I have some friends right now that are expats in Southeast Asia. It might give me an opportunity to go see them. But yeah, I have thought about taking time off, and it's at one point I was thinking, well, once I hit the $1,000 a month goal, which is really, really, hey Gen X, how you doing? Really, inevitable at this point. I'm up to like $930 a month on average, and so all I would have to do is kind of get say a slush fund of like a couple $1,000, and then I'd be able to live off dividends in like most Southeast Asian countries, with $1,000 a month. And I've thought about that, just like almost so I could write about it, almost so I could just be like, I could do this, or how easy it is in other countries rather than the U.S. But there are still some expensive places to live in Southeast Asia. I'm not trying to down talk that. But anyway, it's still, that's too far away from me. So I think retiring, retiring is in never working again, I think is very far away from me. But like retiring is in like not working my 9 to 5. That is a pivot point that I think I'm going to have to make in 6 to 7 years, whether or not I want to continue working. Because I do enjoy what I do on a day-to-day basis. And I know some of you guys don't know what I do, and I'm not really going to say it for personal reasons. But I'm an engineer. I guess I'll say that. But in 6 to 7 years, I think it's going to be like, okay, well, is this passive income aspect of my life doing well enough where I have to actually work here? Or is my life... am I happier not working at this sort of job and actually doing something like I'm doing now, which is like talking to you guys on YouTube and making videos and concentrating on my investing and stuff like that. So, but anyway, I think at some point, I would like to take, some time off and go see other countries. That's why I kind of hit 50 countries by the time I'm 50. And depending on how I do, if I keep, being aggressive, and if I end up moving there's chances that I could move to Southeast Asia for work, or Europe for work, or even Africa for work. I don't really think I could move to South America. Australia is kind of out of the question now. But there's very much a possibility that I could move to a couple other continents, and so it would make it very easy for me to hop from country to country. Just makes it a little bit difficult from the U.S. because the U.S., while the U.S. is so big, and so it almost has like countries within itself, like going from the Midwest to California to Northwest to East. They're all very different. Just like every country, different parts of the countries are different. So anyway. Why out of the question for Australia? Because my current company doesn't really have too much things for me to do. So the current company I work for does have things in Australia, but for me specifically, as for the type of engineering that I do, currently doesn't really have too much operations there. So. But yes, Australia is definitely somewhere rather, I would love to go to. So excited to go there. Do I do business with the government? I don't. I can easily say that part. Man, it would be cool though. I was driving around. So when the company I work for, they're nice enough to kind of hire someone to drive you around and show you some of the area. And I don't work for the government, but what I was seeing is like, oh, here's like this embassy if you need to go there. Here's the European Union embassy if you need to go there. Here's the Colombian embassy. And I was like, oh, these are cool. Saw the American embassy, was kind of unimpressed. And then what I did see is they started taking me some of like the nice areas, because some of the expats, since we're all engineers, we do get put up in pretty nice housing. And some of the managers and presidents and stuff like that, they get put in very nice housing of the company, not for governments or anything like that. And with that, they were like, oh, here's where so-and-so, looked at staying, but they're not staying there. And here's where so-and-so was looking at staying, but not staying here. And so that was kind of fun. But then you started seeing where some of like these diplomats and these ambassadors are staying, and you're like, these companies are paying for this? Or not companies, these countries are paying for, and they're like massive like castles, and you're just like, they're not really castles per se, but it's just like, oh my God, like, and it's like this country, like this small little country is paying for this massive little house. I'm like, that's almost the size of like that country. Like, why do they have this such a nice house? But anyway, very interesting aspect of things, because I never really been to like DC or like that, where you would actually see diplomats and ambassador homes and stuff like that. So it was an interesting thing. I am not a government contractor. I'm a secret agent. Oh man, now you guys are conspiring about, or not conspiring, but trying to figure out what what I do. Oh, you work for the Army Corps of Engineers. That's awesome. I'm not smart enough to work for the Army Corps of Engineers. I'm just going to be very, very blunt. System admin, huh? Network engineer. No, not either of those. Anyway, but yes, I am an engineer. I live in Trinidad and Tobago, so love it so far. Trying to think of any other countries. So at the moment, I've been to Grenada. I'll go to Turks and Caicos. I'll go to Antigua, and obviously been to Trinidad and Tobago. I'm trying to think of what other countries I want to hit before the end of the year. The two easiest are St. Lucia and Barbados. Those are relatively quick, like within 45 minutes to an hour's flight. So those might be easy to add on to, whether it's like before I go home for Thanksgiving or whether it's before I go home for Christmas or something like that. But maybe it's not IT. But yeah, I'm just trying to think what other things you guys have in terms of questions. I'd love to ask any. Oh, local foods, yeah. So don't know about you guys, but one of the things I have asked of some friends is whether or not they believe me starting a Spanish channel would be beneficial. I don't speak Spanish personally, but I have some friends, and this sort of topic is universal. But unfortunately, all I can do, all I can do is, speak in English. And so, I speak a little German, but not much. But I think there's a huge market for this entire conversation that we're having. But unfortunately, I can't have it in Spanish because I don't speak Spanish. And so I asked my one friend. They might be willing to translate into Spanish. I have another friend. She's Indian, so I might have her translate it into Hindi. But anyway. So I'm just curious if any of you guys speak other languages, would it actually be beneficial for you to have it in a different language? Everything that I talk about, and maybe not everything would be translated, not all the videos, but some of them might be. But anyway, but yeah, if any of you guys have any other questions aside from you guys trying to determine what kind of engineer I am, let me know. Before I Mind's in Motion, how you doing, brother? I'm curious what else you guys got. Otherwise, I'm probably gonna I'm probably gonna grab some. So I have thought about doing like a live kind of thing, like driving, because driving, obviously I drive on the opposite side of the road, and so I drive on the left side of the road, and the car is normally where we're used to driving from the left. It actually drives on the right, so it's right-hand drive rather than left-hand drive. And so I have thought about that because most of you guys are either Canada or America, so it might be a little bit interesting to see that. Grocery stores, I was skeptical at first, but I'm pleasantly surprised at what I'm able to get. So yeah, when I first started, I was like, all right, make a left-hand turn, and it would like hit the wipers, and I'm just like, oh God. So it doesn't happen anymore, but definitely guilty of that when it first started. Hey, Catherine, how are you? Oh, you're a lady. Sorry, I didn't mean to insult you there. But yes, it was interesting, and it was a lot of fun when I was in Grenada to drive around there because a little bit less traffic, and so very easy to get into a little bit more trouble. But anyway, trying to think what else is there. But yeah, if anybody has any questions, let me know. I'm just trying to think. So we have a couple other people that just joined, and then a couple other people just left. It's probably Minds in Motion because I called her a guy instead of a girl, so she's probably upset at me. So she probably left already. But I think most of the topic that we've talked about today is just continuing to emphasize that just getting your money in the market. Nah, she's cool. Yeah, she's watched a couple of my videos in the past and commented before, and I've chatted with her in the comment section, but I don't remember too much lately. I think the last time I chatted with her in the comment section was a couple weeks ago, so seemed nice enough to me. One of the things we've been talking about specifically today is making sure that you're continuing to add to your initial investment. I think a lot of people in the comment section are like, what do I do with $5,000? What do I do with $10,000? And it's not just that. I think that's the first step. But I think what the thing is that we're really focusing on today was really long-term investing and understanding what your goals are. And I preach this a lot, and I appreciate that it's probably, really dumb and really mind-numbing for you guys now. But I'm really preaching it because it's very important, because I think a lot of people, every time they ask me, whether it's friends, family, they're like, what do I do with $5,000? What do I do with $10,000? And it's like, that's just the start. The $5,000 and $10,000 is just the start. So if that's just the start, what are you going to do after you start? And I think that that's the important question you need to ask yourself is, $5,000, $10,000, that's just the start. Are you going to continue to invest monthly? Or are you going to, just see where that goes, the $5,000, $10,000, and see how it grows? Because if that's the case, then we're kind of on different wavelengths, and I can't really necessarily help you there. But so that was kind of what we're talking about for those of you guys that have kind of recycled in and out and everything like that. And then I was giving Ryan from Independent Investor crap because I was, not giving him crap, but I was envious of how many people come into his live streams. I think I went in the other day and he had like 50 or 60 people, or maybe he had more, I don't remember, but he had so many people and so many different questions, and I was just like so upset because like I get some questions here and there, but like he has trouble answering them all, and like he'll be like, all right guys, like I'm giving you guys 20 minutes left, and like if I don't get through your question, I'm sorry. But anyway, yeah, for sure, I do. So I guess one of the things I need to do, I was curious if I had a pen and paper. If you guys could, write in some of my videos, make sure that you say what you want. So I guess one of the upcoming videos that I'm really looking at doing is automated investing. And by automated, I don't necessarily mean like it'll automatically invest in Johnson & Johnson or anything like that, but maybe I mean like automatic transfers. So money going to certain accounts, going into one account. What's up, Ernesto? Going into one account and then going immediately into another account. So like M1 Finance account, I have auto. Fundrise, I have on auto. My Fidelity individual brokerage account, I have on auto. I have 2 529 accounts that I set up for my nephews, and I still have to set up for my newborn nieces that are 3 and 4 months old. I need to set those up, but those are on auto. My 401k is on auto. My Roth IRA is not on auto, and that's because I lump sum that in January and February early on in the year. Trying to think what else is on autopilot. I have computer shares where I could set that up on autopilot, but I generally will do just lump sums on computer shares. But yeah, I mean, I would love to talk more about that and almost like show you the web. So that way it's just like at the end of the month, like, yeah, I might still have to check my checking account and see if there's leftover funds in there. But I mean, the majority of my money at that point, like 30% of my money has already just been like spider webbed out and has already been like into the accounts that I want it to go into. And I might just have to add that extra $1,000 or $2,000 that's in the account at the end of the month to make sure I top up and I don't keep too much in the accounts. So So I guess, yeah. Oh, and also, well, I guess the Cardone Capital was a single investment as well, so that's not automated per se, but I still get $50-$60 coming in from that every month. Sorry, I think the uh, channel cut off, but I only have 10% left on my phone, so at this point it's probably getting close to dying. Um, but no, the Cardone Capital yield has not gone up. It's still hanging around 4.5% or so. And so on the 10th, sometime last week, I got another $56 paycheck from them. So I've now gotten, over $160 worth of investment income coming from Cardone Capital. So just over 1%, like 1.1, 1.2% of my initial investment back. And so, in that respect, interesting. The one thing that I was talking about with somebody, though, is because you are investing directly into ownership in the. So far, I'm okay with Cardone Capital. The one thing that I am somewhat weary about is, and I don't necessarily understand, is why, if I'm investing directly into 2 to 3 different multifamily buildings, is my cash flow steady every month? If I was getting $50 one month, $70 another month, $40 the next, that would make sense to me, because expenses kind of go up and go down. They're variable. You might be adding, repainting this deck this month, and refinishing this kitchen this month. But anyway, I digress. So what would I want my stock portfolio to look like when I turn 65? So I've had a broader plan as to what I want my wealth to look like when I'm older. And I would say that it would look very different than it does today. I think what you guys see at the moment is 2 out of the 4 things that I currently do. And I guess you could say 3 out of the 4 that I would want to currently do. So I have my 9-to-5 job. You guys know that. That's my main source of income. And then my second main source of income is my dividend investing, so my stock market portfolio. And my third large source of income on a very general basis is coming from YouTube, so like other personal businesses, Shopify, stuff like that. Very small amounts at this moment. I'm trying to grow that. But I guess you could also say that I do real estate with respect to the fact that I have Cardone Capital, Fundrise. Those aren't really stocks per se. So maybe you could say that that's somewhat. So anyway, what I envision is a different percentage between stock market, having strictly cash, having specific businesses that I'm running, or having, that, and then also a real estate portfolio. And so it's almost like a conglomerate of businesses where I then am the manager of all. And so I have a decent amount of cash, so that way if like the real estate market takes a hit, I can purchase more real estate. I have cash that if I'm coming up short in a couple of my businesses, I have cash to influx, or if I have a good opportunity to buy a business, I have the ability to do that. Or if the stock market goes down, I have the ability to withhold and stand to do that. And so I have percentages made up in my mind. I'm not going to share that with you guys because it's not really important, because it might change. But I would say my portfolio when I'm 65 would probably look very different. I'd say I'd hold most of my money in just the S&P 500 and maybe the total stock market fund, or maybe 3 different funds, like outside a U.S. fund, total stock market fund, total U.S. stock market fund, and the S&P 500. And that being said, is because I'd probably have most of my money in those, because at that point I'd probably be in wealth preservation mode rather than trying to grow. And my thought is, by the time I'm 65, I won't necessarily need the income coming from my stock portfolio. Yes, I will use it, but I think what I'll be is more than an abundance of what I would need. So the goal is at the moment to get my expenses paid off the next 2 to 3, 4 years from my dividend investing. And then after that, almost replace my salary in the next 7 to 10 years. 7 years, I'm hoping to make $100,000 a year, and then within 10 years, hopefully replace my salary. And so, if that's able to be done, and of course that's going to be ever evolving, right? Because my salary is always going to continue to go up, and so maybe. So anyway, that's going to be like an ever expanding sort of goal and very transient goal. But that's where it's at the moment. It's trying to get to 100,000 at the moment in dividend income. But once I get to that point, and once I really start to be able to get to the point where my expenses are paid off, it's almost like stop chasing the yield, more so about keeping the consistency in the dividend payments. So it's like I'd almost, once I get to the $100,000 mark, really start to get to the point where the yield of the portfolio is between 2.5% to 3.5%, because that's a really conservative sort of yield. And so I probably would still invest in the individual companies, but what I might try to do is get on a couple boards or something like that. But of course, boards are not only like ownership related, but also you need to have influence to be able to do that. But anyway, hopefully that gives you an insight as to what I'm looking for at 65. But I think in 7 to 10 years, I'm going to have a really big pivot point as to whether or not I want to stay in the corporate world or kind of do in my, by stay in the corporate world, I mean be an employee or actually start my own businesses, which I do kind of have businesses right now. But anyway. So I have about $15,000 in Cardone Capital. That was a question by Minds in Motion. Christian Gonzalez, I answered that question. My annual return in the stock market since I started. I don't have that number. There's been, I don't have that number because I've bought and sold. And so over the past however many years, I haven't tracked how much I've invested every year. And so, yeah, I hate to say that I don't know the number. Generally speaking, though, when I have checked in on it, Fidelity will tell me that it's keeping track of it, and when it does, it says, I guess the best one to look at per se is my Roth IRA. So my Roth IRA, the total return on my Roth IRA is 40 to 50%. But that being said, that's starting back in like 2013. So that's like $5,000 in 2013. Now recently it's allowing us to invest $6,000. And so I think overall in the past 5-6 years, I've invested say $30,000, and it's grown to say like $45,000, almost $50,000. And so that's probably the best indicator of how I've done. But my individual brokerage account, I'll sell things, I'll buy things over time. Very rarely, I might sell 2 or 3 positions a year. So I generally consider myself a very long-term holder or investor. But it's difficult to say how things have been. And another thing to do is when you look specifically at, say, Fidelity, when I reinvest dividends in my individual brokerage account, and considers that, I was just trying to see if like the shadow is like, this is a big pimple, but it's not. It's just the shadow of my wrinkles on my forehead because I laugh too much. What does it say? Because when you reinvest the dividends, it shows up as additional cost basis and additional investment. And so, which is a good thing with respect to the fact that if you are able to accumulate more shares, and then it also allows you to, get more shares that you can grow in terms of capital appreciation. And also it helps because if you say are reinvesting throughout in dollar cost averaging throughout reinvesting, you could almost use that as tax write-off. So if you have like another 5 or 10 shares and the stock has recently gone down, anyway, it's maybe going too much into detail, but the question was annual return. So that plays into a factor of impacting in Fidelity my return, because while I view that as an infinite return almost, or lowering my cost basis for tax reasons. What just happened? Did a bird just fly into the? I think a bird just flew into the window. Anyway, sorry, I got really distracted by that. For tax reasons, the individual brokerage account counts that as an actual investment. So when I look at Fidelity, it'll say I'm like either breaking even on something or what have you. But then when I look on like my app where I track it, I'll be like 50, 60% up, even though I might say I'm only like 10% up in Fidelity. And that's just because, throughout time, I've just been investing, and say the price goes down a little bit, I'll have prices where I'm buying dividends at like $100 a share and what have you, even though I view that as like free money almost. So maybe not the way to specifically look at it, but for me, that's how I look at it. So total stocks that I own to date, I think is close to like 50. I don't know the exact number, but so I don't have a home, Catherine. I currently live abroad on the company's dollar because I'm a U.S. citizen, but I'm currently living in Trinidad and Tobago for work. And so the company pays for me to be here. And so I'm fortunate enough that they pay for that. But in terms of large purchases, I was fortunate enough to intern as an engineer in 2012. And with that, I saved about half the money that I earned because obviously I didn't have much to purchase back then, except for groceries and beer. So in 2012, when I was 21, 22, I went back to school my senior year, and 3 months before I started full-time working, I was able to buy my truck, and I was able to I had enough money where I could last for 6 months to make the monthly payments before I started working full-time. And so I never really had to do that in terms of like figuring out or planning or investment strategy for that. But I was able to, because the truck was initially was at 8%, because at that moment I didn't have any credit. And so as soon as I could, I refinanced it. I got it down to 3%, which was still not the best rate, but it was still a lot better than 8%. And so I did that in 2014. That actually shaved off an entire year and decreased my payments by like $50 a month, just going from 8% to 3%. And so I was able to pay that off a little bit earlier than I wanted. And all the while I was still investing like a madman. But once I was able to pay that off about a year and a half ago, that was an extra couple $100 a month that I could, continue to invest. And so I didn't buy another car. I kept that car up until when I moved to Trinidad. And then I had to sell it because obviously I wasn't going to be there for the year, and I didn't feel like driving it back to Pennsylvania where my parents lived from Houston, which is where I was living for work. And I didn't want to have to rely on my friends. And I was like, I don't want it to just sit there for a year and depreciate and what have you. And I was like, I can get a good price for it. So I sold it $9,000 and took that money and I reinvested it into the market, which is kind of cool because now, that'll be able to get me $300, $400 a year in dividends just based off of the fact that I sold my car. So that'll be a couple bucks a month in terms of returns. And so that being said, it's like 25 to 40 bucks a month I'm able to use. And so if I'm able to do that, then I'm maybe in a couple of years, I'll be able to use that money to kind of have my own car payment or something like that. So, yeah, I know that didn't really answer your questions because at the moment I don't have a car that I actually own. I have a leased car for the company, but and then I don't own a home per se. anymore. Currently, my entire residence is in Trinidad and Tobago. Everything that I own is in a box here. There's some valuables that I have that my parents' place that I shipped up with them, or that I brought back with me the week before I moved to Trinidad. But yeah, like I would say 95% of what I own is with me here in Trinidad, and the other 5% is like some watches and stuff that I didn't want to bring across country, or to a different country. Christian asks, how does it feel to know that you can retire in another country with your current dividend income? So it's real nice. I think I thought that, I guess when I first started in working, I thought that when I got to about $12,000 a year in dividend income, which is very close to where I am now, I'm like $11,200 a year in dividend income. But I was like, but when I get that, I'm going to go to Southeast Asia, retire for a year, or like take a sabbatical for a year and live there and then return to the workforce. And I think for me, unless something changes, I don't want to say that's a dumb idea. It's not. I think actually in some scenarios, if I were to do that and then document that through YouTube, I would actually end up potentially in a better financial position than I am now, just based off the fact that I would have a lot less expenses, and I would be able to kind of it's an interesting story as well, so I'd be able to get viewership and write that story through YouTube. But at the moment, I really enjoy what I'm doing, and I feel like I kind of have an unfinished purpose with what I do in my current 9-to-5 job. And so I don't want to just leave that high and dry. And so while I am, I don't know what he said. Yeah, I saw what Gen X wrote. I'm avoid that one, I think. And so, what was I say? So I kind of have an unfinished job. But anyway, I'm trying to create other sources of income. So if I do want to decide to make the decision where I am done with the business that I'm working on now, and I don't want to go into management or something like that, I can make that break off. And I can go travel or do whatever. But I think what I'm afraid of, fearful of at the moment, is having the ability to say do Southeast Asia, but then not be able to do like Europe and travel Europe full time, or live in Europe full time, or and so it's difficult to go to some places full time and not live there per se. So like traveling to Europe would be very expensive. Living in Europe would be easier, but that requires you to sign long-term lease agreements and stuff like that. So anyway, it's not out of the realm, and I've thought about it because at the moment I could say go to the Philippines or Vietnam and live off the money that I have. But anyway, and keep in mind that a lot of what I talk about, the dividend income that I talk about, isn't including the money in my 401k. And so if I were to like cash that out as well, that could be an increase of like 30% or so to the portfolio. So if I wanted to just meet my dividend goals and just like throw my potential retirement out of the future, which I've thought about doing, or like a traditional retirement, because that's what a 401k is like a traditional retirement, I could take that 110 or 120,000 that's in there and invest it and get another $3,000 to $4,000 a year, which would really solidify the fact that I would be able to live in like Southeast Asia very easily, because at that point I'd be getting like close to $15,000 a year in dividend income. And part of me has thought about that because it's like, 401k at this point I'm doing really well financially. Am I actually going to need that? And it's kind of like, well, if I just want to keep it far away and I can do it without the 401k, then why do it? Why pay the penalties and stuff like that? You know what I mean? But maybe that's just me being naive or not thinking about it fully. But then part of me has also been like, well, I could use that 401k and start other businesses, like the other 4 pillars of businesses that I want to open up: real estate, my own personal businesses, what have you. And just keep the current money that I have that I talk about in the dividend portfolio as is, and just use that other amount that I generally don't talk about, that other $100,000 in the $350,000 portfolio that I don't talk about. But anyway. So what's the dating scene like in TT? I'm not going to answer that one, but partying is a lot of fun. There are some coworkers that live on the south part of the island, and so while I'd love to hang out with them and I think I would have a lot of fun with them, it's difficult to. I don't want to drink and drive, and I think I would be targeted because I'm an American, and so if I'm caught drinking and driving, obviously that's not good. I don't want to do that anyway, and so it's hard because a lot of the friends that I've made are kind of spread across the country, and so it's getting easier though. I think for me in the future, being able to organize and have a little bit more fun on the party scene would be a little bit easier. So yeah, I wish. I don't. So very few times have I heard the company that I work for allow people to take off more than a couple months at a time. I've heard people take off a month, 2 months, and that's generally when they go from, an engineer or like a normal finance or, supply chain management into line leadership or other types of leadership within the organization. And so, anyway. Yeah, exactly. I don't plan to really touch the 401k. So the tax sheltered versus regular taxable accounts, I can get into that. Excuse me. So I have about 120 or so thousand in my, do I have this somewhere? I know in my old workbook I did. I don't know if in my new workbook I did, because I'm using this other phone to look at the comments, my Trinidad phone to look at the comments in the live stream, live chat rather. I can kind of mentally think about it. So about 110 to 120,000 in my 401k, 45,000 in my Roth IRA, and then the remainder of the $350,000 is in non-taxable accounts. So we have $350,000, and let's just say, to make it simple, 150,000 is in tax sheltered accounts. So that means 290 to 200,000 is in non-tax sheltered accounts. So that means, what is that? That's 60%. So about 40% of it is in tax sheltered accounts and 60% is in non-tax sheltered accounts. 150 out of 300,000. Is that right? It's a little bit off because 50 goes into 350,000 7 times. So I'm a little bit off, but around that. So it's about 60-40, 60% non-tax advantage, 40% tax advantage. You're half Trinidadian? That's awesome, man. I love it here. I joke with people all the time at work that I'm gonna localize and find me a Trinidadian wife from Debe, if you know where that is, and they think it's funny as hell. So I might have said too much, but zero state taxes being from Houston plus 100K working overseas. How do you qualify for a Roth? Was this from older jobs when you weren't making over the limits? So I wish I was making 100K tax-free. I'm not, because I'm only overseas at the moment with my current assignment for less than 365 days. So I don't qualify for the tax advantages of being an expat per se. And so I still get paid almost like a normal salary. Granted, I do have the benefits of the company paying for housing and stuff like that. So, in the car lease and stuff like that. So, I'm not complaining at all. So there's that aspect of things. But I don't get the tax advantages of being a long-term expat, if that makes sense, because I'll be back in country. I came here August 2019. I'll be back in country May, June 2020. So it's not longer than a year. So hopefully that, yeah, I've thought about that as well, because not all my vacation will be taken in the 30 days. And I know that that's kind of like the limit. But because I think it's because I'll be technically have residence within 365 days. I think that that's the cutoff. If I were to be here for, say, like 3 years and not have that 30 days, then I don't know. I don't know exactly everything. You're probably better at it than I am. But yes, I do have to do some financial management in order to get into the Roth. So what ends up happening is I do a traditional IRA, and I'll kind of wait for it to be there a month or two, and then I would then do a what is it called? Is it a rollover? I'm trying not to use the street name for it, but I think you guys can understand what I'm trying to say. I'll roll over the IRA and kind of change it and I think they call it like it's not readjust or something like that, but it ends up being that I can kind of like adjust it and roll it over from a traditional into a Roth IRA after some time. So, but yes, I understand that, but when I do the conversion, I don't make any money. So the only money I'm making off the conversion is having it in there for a couple months. And so the only thing that's building is the minor amount of interest income coming from money markets. And so I generally just leave that money in the traditional IRA. And so now I've accumulated like 18 whole cents into my traditional IRA, and I just move the money from my traditional IRA into my Roth IRA. Yes, what you guys are saying in the live chat is the word I'm trying to avoid. So yeah, is there any other questions? I'm trying to think what time it is. I mean, I'm not trying to avoid the word per se, but it's frowned upon. So it is completely legal what I'm doing. The tax rules are what they are. And so I know a lot of people do it, but it's frowned upon. I've talked to Fidelity. When I try to like mention that to Fidelity and say I want to do X, they're like, what are you talking about? They like try to like absolve themselves of like condoning it. So what I have to do is use like the right word, which I think Hidden Freedom Investing was right. It's like called a Roth conversion. So I think he said that, or maybe it was Gen X. Let me see. Yeah. So it's called like when I call them, I would say like, oh, I want to do a Roth conversion from my traditional IRA. So yeah, so I leave my 401k where it is, but I have thought about, I don't touch the 401k and roll that over. I have thought about that as well, because if I am able to do that, then I go from 45,000 in my Roth IRA to like 150 to 150 to 160,000 in the Roth IRA, and at that point I can almost like do a self-directed IRA and invest in like real estate and and stuff like that. But I think I'll wait for a little bit before I get into that. So I like AT&T stock, but I think at the moment, Christian, it's pretty highly priced. Granted, I was buying at the $31 range, and I wish I. Hey, David, thanks for stopping by. I know you were in here for a while, so I appreciate you stopping by. Oh yeah, David too. Before you go, if you have any other friends that you think would benefit, feel free to share with them. It means a lot. Grow the channel, get some other people in here, and if you're interested, find me on Instagram and ask to see what we can do about the WhatsApp group. And also the WhatsApp group, there's a link in my description of this channel to go to my Shopify store. You can join that way as well. So the automated spreadsheet, I'm trying to think if I have a link readily available offhand, but there's a video, I would say probably like 10 videos back, where I walk through the spreadsheet for like 45 minutes. If you want to watch that, you can. But generally speaking, what happens is the spreadsheet, there's about 5 columns of stuff that you need to enter in the very beginning. And if you have like one account, it's really simple. If you have multiple accounts, it gets a little bit more difficult. Excuse me. But the only thing you really have to enter is the ticker symbol of what you have as your first investment. You have to mention how many original shares you had, how many shares you have currently, the price you paid, and then what sector it's in, whether it's in industrials, IT, financials, energy sector, and that's it. And most of the time, you don't have to ever change the sector, the ticker symbol, and all you really ever have to focus on is the three sectors, or the 3 other columns. So let's say you buy AT&T for $30. You buy 100 shares, and now you have 110 shares. You paid $30 for it, and you know that's in telecommunications. So all you have to do is put the T, and then a lot of other things, which I'll explain, get filled in. You have to input the fact that you have 100 shares originally, you now have 110 shares. You paid $30 for it, and then you input your sector, which is telecommunications. That initial ticker symbol in the sector will never change. At least very rarely would the ticker symbol or the sector ever change unless the company goes through a massive reorganization or rebranding. The only things you'll ever really have to keep track of are, if you reinvest dividends, you'll have to keep track of the current shares that you have. So if you're reinvesting dividends, you might go from 110 shares to 101 shares to 102, 103. So you have to keep track of that. Not a big deal.